My dear friends and investors, welcome back to our monthly video on markets and investing. I'm sure all of you must be eager to hear what is happening in the markets, considering that we have seen a fairly decent and steep correction across the board. I'm also eager to communicate my views, and I hope that though this may be a slightly longish video, I'm able to communicate very clearly to you what has been happening and what do we see as the prognosis going forward. So let's start with the most crucial question: what led to this correction? And as you all know, that the broader markets have been in a correction from September 2024. The real deep correction only started from January. And a large part of this correction has its genesis in the fact that the economy slowed down considerably in Q2 and Q3, which in turn led to a significant slowdown in earnings growth. So if you carefully look at the chart of the NSE 500 earnings growth trajectory over the last few quarters, what you will see clearly is that the quarterly earnings run rate reached a peak in Q3 of 24 of roughly about 27%. And then from Q4 of last year, the quarterly earnings started to decelerate and it went to 13.2. Q1 of this financial year to 4%. Q2 actually negative 1.3%. And now Q3, we've seen a bounce back to 8.5%. So you can see how steep was the aggregate earnings fall, especially in the first quarter and the second quarter of the current financial year, and that actually coincided with the correction in the markets. However, if you were to take away the more volatile part in the NSE 500 companies. So what we've done is that we've excluded oil and gas, metal, mining and commodity companies from the universe because that's the more volatile part of the universe. Then you will see that even though earnings have decelerated, but the deceleration was not that severe. So from a peak of almost 23%, the earnings growth in Q1, Q2 and Q3 was still healthy double digits, right? However, on an aggregate basis, we did see significant deceleration, and that to my mind was the first trigger for the correction to set in. If we now just focus on the third quarter earnings, where was earnings very healthy in which sectors and which were the laggards? Pretty much, if you remember, the list is exactly the same that we saw in Q2. Similar trends we have seen in Q3. The standout sectors in Q3 were agrochemicals, partly because the base was lower. So this year and in third quarter you had very good rebound. Infrastructure, including real estate, was very strong. Consumer durables, including EMS companies, exchanges, cap goods, and then new age and e-commerce companies. So these were the 5 or 6 sectors which clearly outperformed and delivered very strong revenue, EBITDA and PAT growth. Who were the laggards? Textiles, chemicals, plastic products, energy and commodities. So the more volatile and the more commodity kind of businesses actually delivered very poor results in Q3. And as a result of the falling trend in quarterly earnings, we have seen that the markets have corrected significantly. As you see, if we were to look at just this calendar year from Jan up until end of Feb, the Nifty is corrected at 13%. The Nifty Next 50, incidentally, they also include large caps and larger mid caps, but that saw a significant correction of 24%. The Nifty mid cap was down 19%. The small cap was down 22%, and NSE 500 was down 16%. However, if you look at the golden bar, that tells you the real pain. The fall in the index actually masks the real pain. So the bar tells you that the median correction in the top 500 companies was actually 33%. For the small cap, it was a staggering 37%. For mid caps, 33%. The next 50, which is just below the top Nifty 50 stocks, that was also down a staggering 37%. And even in the Nifty, it was 18%. So if you really look at it, barring the top 50 stocks in the Nifty 50, almost on a secular basis, the median correction in every market cap category, including the next 50 stocks, has been in excess of 35%. And therefore, as you know, that the pain in the portfolios is significantly higher than the pain as reflected in the correction in the indices. Let's further look at the nature of the correction. The general perception has been that high PE stocks have corrected more than low PE stocks. So what we did was that we divided the stocks into PE buckets, and what we see is again very interesting. Companies which were in the up to 15 PE bracket have corrected by only 11%. But if you look at every other PE bracket, 15 to 30, 30 to 45, 45 to 60, and above 60, almost all of them have corrected between 14 to 16%. And therefore, this is the average fall in stock price after the Q3 results were announced. So that's from Jan to Feb 18th. And therefore, it's not as if that only high PE stocks have corrected. Anything which was above 15 PE has corrected almost in a similar manner. We also correlated the stock price to EPS upgrades and downgrades. So what's an upgrade? So let's say a company declares the results, and then based on the third quarter numbers and some of the commentary that the companies give, analysts generally either take up their future forecast or bring down their future forecast. And when you look at that trend, you will see that the biggest downgrades were in companies which had PE above 60, which is roughly about a 7% downgrade in earnings. But it was very similar even in low PE companies, where post results the downgrade was 6.2%. And then the rest of the PE bands were all over the place. The point I'm trying to make here is that the perception that only high PE stocks have corrected or have seen a significant downgrade in earnings is not borne out when you look at granular data of earnings. The correction has almost been secular, and by and large every market cap category has been impacted. Not just small caps, not just mid caps, even the broader markets have corrected almost on a median basis in a similarly significant manner. So before we move ahead, let's summarize what we have said so far. What we said was that because of the election related slowdown in Capex spending, the economy slowed down, which in turn led to a slowdown in earnings, which in turn triggered a correction in the market in September last year. And the fall in the market was more accentuated starting from January, with an added layer of uncertainty because of President Trump's tariff and trade policies. Now the correction was almost severe when we look at it from a median stock fall perspective. Almost all market cap ranges have corrected other than the top 50 stocks. The average fall has been greater than 30%, and there is a misconception that only high PE stocks have fallen. So let's move ahead from here. Therefore, with all these corrections, where do we stand as far as the market valuation and the situation is concerned? While on a broad Nifty basis, our valuations have now corrected to a very healthy 18 times 1 year forward. However, I'm sure a lot of you would have heard that India is very expensive, and hence we are seeing FIIs continuously selling in the Indian market. And hence we looked at India's relative valuations compared to the world equity market valuations. And what we have compared is the MSCI World Index versus the MSCI India Index. And if we look at the last 10 years, that is from 2015 right up to 2025, what we find is that India always traded at a premium to the world equity markets, and that average premium over the last 10 years has been roughly about 21%. So India always was a premium market. However, as things stand today, that premium has shrunk to just 2%. So from an average of 21%, we are now down to 2%. And it is only 6 times in the last 10 years has the valuation of the Indian markets converged with that of the world markets. And usually whenever that has happened, in a few months, we've seen that the markets have turned back into and tended to move towards the average premium. The second indicator which you will now see is what we have done is that we have looked at the percentage of total stocks which are trading above their 200-day moving average. So what's the significance of a 200-day moving average? A 200-day moving average is an important technical indicator which indicates the strength of a stock price of a company. Generally, when companies trade above 200-day moving average, they show strength. When they trade below or significantly below 200-day moving average, they show weakness, or it denotes a weakness. And therefore, when you see this graph, it's actually a very sharp graph that goes up and down. If we focus on the lower points of the graph, it tells you that there have been very few occasions in the last 23 years, and this data is from 2002 right up until recently in 2025. Only in 5 other instances in the past, which is 2006, 2008 during the global financial crisis, 2018 when there was a big sell-off in mid and small cap stocks and the breadth of the market was very bad, in 2020 in COVID, and now the 6th time in 2025, where only 10% of the companies listed are trading at above their 200-day moving averages. What it means is that 90% of the stocks are trading below or in a severe downturn. So with such extreme readings currently, we do believe that there is a very high probability that the markets are massively oversold and that we should see a rebound, which could be any time over the next few days or probably the next few weeks. So now what? The markets have reacted both because of domestic and international factors like trade and tariffs. However, where do we go from here? If you look at the domestic situation, as I said, the slowdown was triggered by the slowdown in the economy, but we now have the figures for Q3 GDP growth. And as you can see again from the chart, that after slowing down from 6.5% in Q1 to a low of 5.6% in Q2, GDP growth has again rebounded to 6.2% in Q3 and is expected to rebound back to 7.7% in Q4 of this year. So the economy is already on the mend. Another indicator to give us that confidence that the economy is bouncing back is when you look at the quarterly trend of GST tax collections. Again, if you look at the chart, you will see that Q1, Q2, Q3, Q4 of 23-24, all the 4 quarters, we had almost a double-digit GST growth, and it was in the current year that we started to see a deceleration, where in Q1 you were just barely at double digits at 10%, and then in Q2 and Q3 the GST revenues fell to 9% and then 8% growth. And now we have the data for January and February of 2025, and we are seeing that the GST collections are again rebounded from single digit back to double digit 11%. And that means that economic activity has started to rebound. We did mention this last time after the budget was presented. We now have data of Capex spending right from April up until Jan. Out of the 10.2 lakh crores that is budgeted now for the current year, for the first 10 months, the government has already spent 7.57 lakh crores. And as you can see from the chart, that December was a big month with a rebound at 1.72 lakh crores. Jan was slightly lower at 72,000 crores. However, assuming that we will spend all that we've budgeted for in the current year, Feb and March should be clearly upwards of 1 lakh crores. And then for the rest of the financial year, which is the year 25-26, we should be spending at the run rate of about 93,000 crores a month, and therefore I believe that Capex is also rebounding after a slowdown last year. Another indicator of the health of the economy is the Naukri JobSpeak Index. Naukri JobSpeak Index looks at hiring trends across several sectors. And the latest reading that has come in February shows a significant rebound from a low of almost 2430 in November. We're now up to 2890, which is even higher than February of last year. So this is also good news. And if we look at the breakup of who's hiring, a large part of the trend was a 21% growth in AI and ML, which is artificial intelligence and machine learning professionals, hospitality and travel 20%, real estate and property 9%, FMCG 8%, pharma 5%, and so on and so forth, right? So this also is another data point. So when you look at GDP growth, or you look at GST collections, or you look at the job hiring trends, they all point to an economy which is quickly recovering. Finally, as you all know, we have a new RBI governor, and very clearly the RBI governor has pivoted from running a very restrictive monetary policy to a relatively more benign monetary policy stance. So we've seen not only a 25 basis point rate cut, we've started to see that the RBI has started to infuse liquidity into the banking system, which was running at a deficit. And on top of that, the latest regulatory policy was to reduce the risk weights for lending to NBFCs and MFIs. Last year, the RBI had significantly disincentivized growth in credit, liquidity was tight, and provisioning norms were also made tighter. What we are seeing is that the new RBI governor is now letting loose some of those very strict provisioning and reserve requirements. And therefore, we are seeing that both from a fiscal perspective, with the tax cuts in the budget, Capex recovering, and monetary policy easing, we believe this should all feed into a revival and rebound in growth in the economy, and hence going forward we also believe this will start to get reflected in a revival in earnings growth as well. And therefore on the domestic side, we are clearly seeing significant green shoots of revival. So the only risks that I see on the horizon now is the uncertainty regarding President Trump's trade and tariff policies. However, I do believe that the worst of that should be priced in by early April, when most of the tariff actions are already taken and hopefully will be in the price. The other risk is that of a disorderly correction in the US markets. As you all know, that the US markets were largely powered by the bull run in AI stocks, and that could be under threat given the fact that today China has also created a rival AI model by DeepSeek. And if that were to come under threat, and if there is a disorderly correction in the US market, then that could pose a risk to all asset classes. So barring these two, I do believe that given the extremely oversold conditions that we are seeing, which are at almost historic levels, given the fact that the economy is already on the mend and the monetary policy is starting to become favorable, I do believe that investors should step outside of their comfort zone and start allocating to equities. From here on, while there could be a few risks, but I do believe that the returns over the next 2 to 3 years far outweigh the risks at current point in time. In my humble opinion, I think we may have just seen almost the worst getting priced in. I am fairly confident whatever incremental cash that we have in the portfolios, we are very clearly on our path to deploying all of that over the next few days, as we believe that the risk reward in the markets is favorable at the current point in time. Thank you again. Until next month.